Welcome to this CAMS exam preparation lesson on shell, shelf, and front companies, and the critical concept of beneficial ownership and control. By the end of this lesson, you will be able to distinguish these entity types, trace ownership through layered structures, and apply thresholds correctly. These topics appear frequently on the exam, so let's build your understanding step by step. We begin with foundations, what these entities actually are, and why they exist in legitimate commerce before criminals exploit them. Let's draw the key distinctions clearly. A shell company has no active business operations and few or no significant assets. It exists as a legal vehicle, perhaps to hold intellectual property, facilitate a merger, or park funds during a transaction. A front company is fundamentally different. It has real operations, a restaurant, a car wash, a trading firm. The criminal uses that legitimate revenue stream to mingle dirty money with clean, making proceeds appear to come from normal business activity. For the exam, remember, shell means no operations. Front means active operations that disguise illicit funds. A shelf company, also called an aged or ready-made company, is found by a service provider, left dormant on the shelf, and then sold to a buyer at a later date. The buyer gains an entity with an established incorporation date. Legitimately, this saves time, but criminals exploit it because the company's age may help it pass initial due diligence checks, and the change of ownership at sale can obscure who truly controls it. On the exam, distinguish a shelf company by its defining characteristic. It was preformed and sold, not created by the current owner. Now let's move into the concealment mechanisms that criminals layer onto these structures to hide who really owns or benefits from them. Four tools appear repeatedly in exam scenarios. Bearer shares grant ownership to whoever physically holds the share certificate. There is no registry entry, making the owner invisible. Nominee arrangements place a third party's name on the register while the true principal remains hidden behind a private agreement. Secrecy jurisdictions offer weak disclosure laws, no public beneficial ownership registers, and limited cooperation with foreign authorities. Finally, complex ownership chains stack multiple entities across different countries. Each layer adds opacity. Combined, these tools make tracing the natural person extremely difficult, which is exactly the point. With those concealment tools in mind, let's tackle the core concept, beneficial ownership. This is where the exam tests your ability to trace through layers and identify the natural person at the end of the chain. The exam frequently tests whether you understand the difference between ownership and control. Ownership means holding shares, directly or indirectly, in the customer entity. You calculate it by tracing percentages through each layer. Control is different. A person may exercise control without owning a single share. They might hold veto rights, appoint or remove directors, or exert dominant influence through contractual arrangements. Why does this matter? Because if no one meets the ownership threshold, you must then look for the person who exercises control. These are two separate tests applied in sequence. Let's walk through the indirect ownership calculation, a skill the exam tests directly. First, identify the chain. Map every entity sitting between the customer and the natural person at the top. Second, multiply the ownership percentages at each link. If person X owns 60% of company A and company A owns 50% of company B, then X's indirect stake in B is 60% times 50%, which equals 30%. Third, compare the result to the applicable threshold, typically 25%. 30% exceeds it, so X must be identified as a beneficial owner. Fourth, if no natural person meets the ownership threshold, identify whoever exercises control. Fifth, and this is the last resort, if neither an owner nor a controller can be identified, record the senior managing official. The exam calls this the notional beneficial owner. You must always end with a natural person on file. Thresholds are not fixed in stone. The standard is often 25%, but institutions must lower it when risk demands. For high-risk sectors, such as casinos or money service businesses, regulators may require identification at 10% or even lower. If a politically exposed person or PEP is involved, a lower threshold may apply automatically. Jurisdiction-specific guidance can also mandate reduction. For the exam, remember that lowering the threshold means more natural persons must be identified and verified. It widens the net. Now that we understand the structures and the ownership framework, let's look at how to spot misuse in practice, the risks, red flags, and controls you need for the exam. These structures carry inherent money laundering risk for four main reasons. They provide anonymity, shielding the criminal's identity from authorities. They enable cross-border layering, frustrating investigators who must coordinate across jurisdictions. They often have minimal operations, meaning less natural scrutiny from counterparties or regulators. And they are cheap to establish and easy to discard once they have served their purpose. The key principle: the less substance an entity has, the higher the risk. Here are the practical red flags you should recognize. Nominee shareholders with no clear commercial rationale. Why would a legitimate business hide its owners? Frequent changes in ownership shortly after incorporation. This may indicate the entity is being passed along a laundering chain. Revenue that is inconsistent with the stated business activity, a hallmark of front company abuse. Registration in a secrecy jurisdiction with no local operations, suggesting the jurisdiction was chosen for opacity, not commerce. And reluctance to disclose beneficial owners or provide supporting documents, a direct obstruction of due diligence. Proportionate controls follow a logical sequence. Verify beneficial owners all the way to the natural person. Do not stop at another corporate entity. Obtain source of wealth documentation. Understand where the money came from, not just who owns it. Apply enhanced due diligence or EDD when the structure is high risk, more layers, secrecy jurisdictions, or PEP involvement. And monitor for changes, new directors, ownership transfers, or sudden shifts in transaction patterns. The overriding rule: controls must pierce every layer until a natural person is identified. Pay special attention to this concept: the notional beneficial owner. When no natural person meets the ownership threshold and no controller can be identified through voting rights or other means, the institution must record the senior managing official as the beneficial owner of record. This is a last resort, not a shortcut. Firms cannot simply say no owner found and leave the field blank. International standards, including FATF recommendations, require that a natural person is always on file. On the exam, if a question describes a situation where ownership and control tests both fail, the correct next step is to record the senior managing official. Let's test your understanding with 3 CAMS exam-style questions. Take your time with each one. Question 1. A customer is a company registered in a secrecy jurisdiction with bearer shares and no visible operations. Which type of entity does this most likely represent? Is it A, a front company laundering through legitimate sales? B, a shelf company purchased for its incorporation date? Or C, a shell company used to conceal beneficial ownership? Pause and consider which characteristics match each definition. The correct answer is C. A shell company used to conceal beneficial ownership. A shell company has no active operations or significant assets and exists primarily as a legal vehicle. The bearer shares and secrecy jurisdiction amplify the concealment risk. A front company would need to have active operations generating revenue, and a shelf company is defined specifically by being preformed and sold, not by its current features. Question 2. Person X owns 60% of company A, which owns 50% of company B. What is X's indirect ownership of company B, and does it meet the standard 25% threshold? Is it A, 30%? Yes, it meets the threshold. B, 50%? Yes, it meets the threshold. Or C, 20%? No, it does not meet the threshold. Work through the multiplication. The correct answer is A, 30%, and yes, it meets the threshold. Multiply each link in the chain. 60% times 50% equals 30%. 30% exceeds the standard 25% threshold. So person X must be identified and verified as a beneficial owner of company B. Option B incorrectly takes the higher figure without multiplying, and option C uses the wrong calculation entirely. Question 3. An institution cannot identify any natural person who owns or controls a corporate customer above the threshold. What should it do next under international standards? Is it A. Decline the relationship as the risk is too high? B. Record the senior managing official as the notional beneficial owner? C. Accept the entity with no beneficial owner on file? Or D. Lower the threshold until a natural person qualifies? Think about the sequence of steps we discussed. The correct answer is B. Record the senior managing official as the notional beneficial owner. International standards require that when no natural person meets the ownership or control test, the senior managing official is recorded as the beneficial owner of last resort. This ensures a natural person is always on file. Declining the relationship is not mandated at this specific step. Accepting with no owner on file violates requirements. And artificially lowering the threshold is not the prescribed remedy. It is a separate risk-based decision made before this point. Let's recap the key takeaways from this lesson. Shell companies have no operations. Front companies mingle illicit funds with legitimate revenue. Know the difference. Criminals exploit bearer shares, nominees, secrecy jurisdictions, and complex chains to hide behind layers. To calculate indirect ownership, multiply the percentages through each entity in the chain. Thresholds default to 25% but must be lowered for higher risk situations. And the last resort rule, always record a natural person. If ownership and control tests both fail, the senior managing official becomes the notional beneficial owner. For the exam, remember the sequence. Ownership first, then control, then senior managing official. You must always end with a natural person on file.